Bitcoin. I could give a shit, to tell you the truth.
You open your phone, check your portfolio, and your stomach drops. Bitcoin is down 20%. Panic. You start frantically scrolling the news, seeing headlines with phrases like the Fed and interest rates. But it feels like you're trying to read a different language. While you're left feeling confused and blindsided by a market that seems to move on invisible strings, the big institutions are already placing their next bets. They speak the language of liquidity, incentives, and policy, and they're positioned to react faster when those signals change. But what if you could learn that language? What if you could see the signals before they happen? In this video, we're going to break down exactly how the decisions made by a small group of policymakers, central bankers, can drive powerful expansions or long, grinding drawdowns. We're going to demystify this whole thing, and by the end, you'll be able to anticipate these huge market shifts. We're going to show you how to start reading the signs for yourself. Before we connect the dots to Bitcoin, we need to understand who's actually in control. We need to talk about central banks. So, what are central banks and what do they even do? Think of the economy as a giant, complex plumbing system. Money is the water flowing through it. Central banks, like the Federal Reserve in the US, usually just called the Fed, are the master plumbers. Their main job is to control the flow of that water, making sure there's not too much, which causes flooding, that's inflation, and not too little, which would make the pipes run dry, that's a recession. They have two big goals: keep prices stable and make sure as many people as possible have jobs. To do this, they have two main tools. The first and most famous is interest rates. In simple terms, an interest rate is the cost of borrowing money. When the Fed raises interest rates, it gets more expensive for everyone to borrow, from you getting a mortgage to a business trying to expand. This makes people spend less and cools down the economy. On the flip side, when the Fed cuts rates, borrowing gets cheaper. This encourages people to spend, helps businesses invest, and gets the economic engine running hotter. Their second tool is a bit more complicated but just as powerful: quantitative easing, QE, and quantitative tightening, QT. Let's stick with our plumbing analogy. If interest rates are the main valve, then QE and QT are like adding a massive water tank to the system or draining the one you have. Quantitative easing, QE, is often just called money printing. During a crisis, a central bank digitally creates money and uses it to buy things like government bonds. This floods the system with fresh cash, or liquidity. The idea is to make money so cheap and easy to get that it forces banks to lend and investors to spend, shocking the economy back to life. We all saw this happen with the massive QE program during the COVID-19 pandemic in 2020. Quantitative tightening, QT, is the exact opposite. This is the money-destroying phase. The central bank sells the assets it bought or just lets them expire. This pulls money out of the system, draining that water tank. It makes money harder to come by, which helps slow down an economy that's getting too hot and causing inflation. Everything else, stocks, bonds, real estate, and Bitcoin, reacts to that flow. So, to recap, central banks control the money. Interest rates are their day-to-day tool, and QE or QT are for more extreme situations. If you're realizing this feels like learning a new language, that's intentional. We actually walk through this entire framework, liquidity, rates, inflation, and Bitcoin's role, step by step in the first module of the Macro Investing Masterclass. That module is free, and it's linked below. Now, for the main event. How does this all mess with Bitcoin? The link between central bank policy and Bitcoin really comes down to one thing: risk. Bitcoin has often behaved like a risk-on asset during liquidity expansions, especially when policy is easing. But that behavior is evolving as it matures into a macro asset. Its price is hugely influenced by how much appetite investors have for taking chances, and that appetite is almost entirely dictated by the central banks. Let's break this down into two environments: the easy money era and the hard money era. The easy money era: low interest rates and QE. This is when central banks are in full-on stimulus mode. They've cut interest rates to near zero and are pumping the system full of cash with QE. This creates the perfect storm for an asset like Bitcoin. First, investors are desperate for returns. When safe things like government bonds pay almost nothing, investors have to look elsewhere. They start taking more risks, moving from safe bonds to stocks, and finally to the riskiest assets with the highest potential reward, crypto. Suddenly, Bitcoin looks incredibly attractive. Second, there's just more money floating around. With all this new cash, it has to go somewhere. A lot of it finds its way into speculative markets like crypto, pushing prices way up. Let's look at our first case study, the COVID-19 rally of 2020 to 2021. In March 2020, as the world locked down, the Fed acted fast. It dropped interest rates to basically zero and unleashed a historic wave of QE. After a brief panic, what happened next was a textbook example of easy money fueling a crypto bull run. With cheap money everywhere, investors piled into Bitcoin. Over the next year, Bitcoin's price skyrocketed by over 1,000% from its low, showing a direct, powerful link between the Fed's actions and crypto prices. The hard money era, high interest rates, and QT. This is when central banks are fighting inflation. They're raising interest rates fast and pulling money out of the system with QT. This is basically a giant fire extinguisher for risky assets like Bitcoin. Here's why. When interest rates are high, those safe investments suddenly look great. Why gamble on volatile Bitcoin when you can get a guaranteed return from a government bond? This creates what's called an opportunity cost. This switch causes a flood of money away from risky assets and into safer ones. The system dries up. On top of that, high interest rates tend to make the US dollar stronger, which makes Bitcoin more expensive for anyone buying it with other currencies, hurting global demand. Let's look at another case study, the crypto winter of 2022. After inflation shot up to 40-year highs, the Fed began one of its most aggressive rate hiking cycles ever. Starting in March 2022, they cranked rates up from near zero to over 5%. The effect on Bitcoin was brutal. As money disappeared and investors ran from risk, Bitcoin's price collapsed. It fell from a high of over $47,000 to a painful low of around $15,500 by November. During this time, Bitcoin started trading almost exactly like a risky tech stock. Its correlation to the Nasdaq was incredibly high, proving that when the money gets tight, Bitcoin acts less like digital gold and more like a speculative tech investment that gets hit even harder than the rest of the market. This is exactly the transition Jerome Powell was pointing to when he described Bitcoin as competing with gold, not the dollar. If you're finding this breakdown helpful for making sense of the crypto markets, you should subscribe to our free newsletter. We break down complex market events like these into a simple weekly email, giving you the key signals without all the noise. It's another tool to help you stay ahead. The link is in the description. Now, it would be easy to stop there and just say, low rates good, high rates bad. But the reality is a lot more complicated. The best investors know the exceptions to the rule. This is why we've been talking so much about liquidity, inflation, and monetary plumbing on this channel. Bitcoin doesn't exist in a vacuum anymore. To really get an edge, you have to look deeper. If you imagine a chart with the Fed's interest rate in one color and the Bitcoin price in another, the story becomes obvious. As the rate hikes of 2022 go up, you'd see the Bitcoin price fall off a cliff. And when rates were flat on the floor in 2020 and 2021, you'd see Bitcoin begin its epic climb. The data shows a clear inverse relationship. But Fed policy isn't the only thing that matters. Let's talk about the other big factors you have to watch. First up is Bitcoin's internal rules, specifically the halving. Roughly every 4 years, the reward for mining new Bitcoin gets cut in half. This is a pre-programmed supply shock. It makes new Bitcoin scarcer, which can create powerful upward pressure on the price, sometimes even when the big picture economy looks bad. For instance, a lot of Bitcoin's big surge in 2023 happened while the Fed was still holding rates high. Why? because the market was already looking ahead to the next halving in April 2024, getting ready for that supply crunch. This internal cycle can sometimes overpower what the central banks are doing, at least for a while. Second, there's regulation and institutional adoption. This has become a huge driver. The approval of spot Bitcoin ETFs in the United States in early 2024 was a game changer. It opened the floodgates for billions of dollars of institutional money to pour into Bitcoin. As these big players manage their portfolios based on Fed policy, it ties Bitcoin even more closely to those macroeconomic signals. Finally, you have to consider market psychology and the reason for a policy change. It's not just what the Fed does, but why they do it. A rate cut to boost a healthy but slowing economy is very different from a panic cut during a financial crisis. In 2020, those panic cuts actually helped Bitcoin, reinforcing its story as a digital gold safe haven from a failing system. But at other times, rate cuts might just make investors prefer normal stocks over crypto if the economy seems stable. This brings us to the current landscape as of early 2026. Right now, the market is in a really interesting spot. Bitcoin is consolidating after a big run, with prices trading in a wide, uncertain range. After a series of rate cuts in 2025, the Federal Reserve is now in a holding pattern, watching the economic data. Analysts and markets expect more rate cuts in 2026, but nobody is sure when or how fast they'll come. The Fed is walking a tightrope, trying to help the economy without letting inflation get out of control again. This uncertainty has the market on edge. Every new inflation or jobs report causes a stir because everyone is trying to guess what the Fed will do next. This is why you see Bitcoin react so sharply to economic news. It's all part of the game of trying to front-run the Fed. So, what does this all mean? The complex dance between central banks and Bitcoin is really a battle of competing forces. On one side, you have the central banks controlling the world's money. Their policies on interest rates and QE create powerful tides that can lift all boats or leave them stranded. As a liquidity-sensitive asset, Bitcoin has historically been extremely sensitive to these tides. Easy money fuels incredible rallies, while tight money hits the brakes hard. It's not a one-to-one switch, but liquidity is the dominant tide. But on the other side, you have Bitcoin's own unique DNA. Its programmed scarcity from the halving, its growing acceptance by huge institutions, and its powerful story as a decentralized alternative to the very system the central banks run. The game for investors isn't just about understanding Bitcoin anymore. It's about understanding the world it lives in. The real key is to anticipate what the central banks will do next. Are they more worried about inflation, or are they shifting to prop up a weak job market? The answer to that question will likely decide where the money flows and where the price of Bitcoin goes from here. By understanding this dynamic, you stop being a passenger tossed around by the market and become a navigator who can actually read the map. As Bitcoin continues moving from speculative trade to macro asset, understanding central bank behavior isn't optional anymore. It's the baseline. If you want to stay ahead of these critical market-moving forces, make sure you subscribe and hit the notification bell. You won't want to miss our next update.